This is segment 2 and a special edition of The Mortgage Voice with Jeff Barton. His guest is Nina Penny as they discuss the particulars of reverse mortgages.
Can you go through some of the qualifications prior to even getting to this point? What do you have to do to qualify to be able to even get a reverse mortgage? It's not for people who are younger. It's really for people who are retired.
Right. So we have to have at least one borrower who is 62 or older. Okay. So like, for instance, you say you're 65. I'm not quite 60 yet. But if we were married, you know what? It would work. We would just base the numbers off of me because, of course, I would be younger than you. And it would be expected. We would kind of estimate that I'm going to live longer than you.
Right.
I don't think that's going to, because I know you're in great shape, but let's just say that's their thinking. So the number's going to be based on me. We have to have equity in the home. Okay. So I like to use as a rule of thumb 50%. The older you are, the more access you will have to funds. If you have a mortgage, let's say your home is worth $500,000 and you have a $100,000 mortgage on the home now, the first thing that's going to be done is we're going to pay off your existing mortgage. Okay. So if your home is worth $500,000, we're going to figure 50%. So you'd probably get $250,000 that you would have access to. We're going to pay off your present mortgage of $100,000. So let's say your mortgage payment, principal and interest is $1,000 a month. You've just increased your monthly income by $1,000, right? Because you no longer make that mortgage payment, but you will continue to pay taxes and insurance. So then let's say you still have $150,000 sitting in that kitty. That is your funds. However you want it, you can take it. You can take it in a monthly payment, kind of like an annuity. You can take it a specific amount of money for a specific amount of time. You can take it out only when you need it and leave the rest in the line of credit. It's basically your money. However you want it, you can have it.
That brings up a point, an interesting question. So this is kind of like a HELOC without being a HELOC, right? This is a certain way to do it. Now, I know that in declining markets or when real estate prices go down, that if you did have a HELOC, that the either the interest rate would go up or the amount of money you could borrow went down. Does this kind of situation exist in a reverse situation like we're talking about?
No, not at all. Actually, this is one of the things is that before the market, before the market had that major downturn, okay, a lot of people said, my safety net is my HELOC. Me personally, I had a safety net. It was my home equity line of credit. If something happened in the house, I went there. It was a nice thing to have. And a lot of seniors figured that as their, go-to fund if they needed it. Well, when the housing market, crashed, the first thing the banks did was they didn't want that risk. So they cut them all. If they didn't cut them down to a minimal amount, they closed them.
Right.
Okay. A reverse mortgage will never happen. That's your funds. It has turned out in times, and I've seen it on occasion, where your line of credit amount you can tap into is actually more than the value of the home. But the mortgage insurance that you've paid up front protects you from never having that happen.
I see. So, that really relieves a lot of people out there who are looking towards the HELOC or looking towards the reverse mortgage as the solution to when either the market goes bad or there's some issues that they need to tap into money right away. How are they going to do it? Yeah, this is a solution that they don't get hurt, and that's the important thing. Another question I have for you is, if the home decreases in the value, does the line of credit decrease as well? Oh yeah, you just answered that. Okay,
No, it does not.
Right, exactly. Okay, and what are some of the ways that people are using reverse mortgage to push out their Social Security? Because I know at 65, I get more money from Social Security, obviously, if I wait till 70 years old. So how do you fill that gap years when, you might not be working or the income isn't coming in, but you want to maximize what you can, get from Social Security?
a lot of people, a lot of people nowadays, we're finding more and more people have longevity, right?
Right.
I mean, there's a lot of people living to late 90s. And
Yep.
so they're trying to set up, hey, you know what? We got to make sure we have enough money in case we live that long, right?
Right.
So number one is that people say, well, if I push out my Social Security and I leave my assets or my retirement in place, if I can bridge that gap between 62 and 70, that's going to get my chances of being successful in retirement so much more. But how do you do that? Do you continuously work till 70?
Right.
So taking out reverse mortgage. So let's say your scenario, okay, that you own your home free and clear, you have $500,000, right? You want to retire, you don't want to work anymore. But Social Security, if you can push it out for the next, until you're 70, you'd give yourself a 9% raise, which is pretty
Right.
good.
Yeah.
Now, if you take out reverse mortgage and use the funds from the reverse mortgage to carry you over those 7 years, right?
Right.
Your interest that you're paying on that reverse mortgage is probably 3.5%. So you use the reverse mortgage to cover you in your finances on your income until 70 when you take Social Security. You leave your assets be and you just use the reverse mortgage. And I mean, it's almost crazy. Who wouldn't borrow money at 3.5% to get a 9% return?
Well, right. Yeah, exactly. I mean, if you're going to get 9% at 70, let's say,
Right.
but if you start at 65, you're going to get 9% less. Obviously, it's more advantageous, especially if what you're talking about in the reverse is a very small 3.5%. That's pretty cheap. Now, how does that rate does it fluctuate? Does it not fluctuate? Well, how is that determined?
We have different options. We have a yearly adjustable and we have a monthly adjustable. I don't know anyone that's done a monthly adjustable. So we use the yearly adjustable. Okay, so it's the margin plus the index equals the rate. Okay, so when at the end of 12 months, they take the previous 12 months rates every month and they average it out.
I see.
And that is your new rate for the next year.
I see. And that is every year they do that?
Every year on the anniversary of when you took out the loan, your loan is adjusted.
I see. And how does it compare to general rates, I guess? And I know everyone out there is wondering because rates are very rate conscious, but historically, this reverse mortgage has always been a very low rate. Is that right?
Historically, yes. It's built in with the 10-year swap, and which is a LIBOR rate. And then it's not so much the rate as it is the margin. Certain loan officers, it's not so much the rate, it's the margin that gets added on to the rate.
I see.
And that makes the biggest difference. But I mean, when I sit down with clients, I show them historically, because they say, oh, it's adjustable rate, I don't want that. But when I show them what the LIBOR, what that index has done for the past 20 years, they look and like, that's it? Yeah. And I mean, that was through some good times and some very bad times.
Right. Okay. Let's switch a little bit here. I know you have some graphics that you wanted to share with us about some of the advantages to be able to use.
To do the reverse? Sure.
Yes, ma'am. If you could just share with us a little bit about that graphic that their viewers are seeing on their screen, a little bit of information about what this means.
Sure. And, a lot of people talk about, downturns in the market, right? So
Right.
we all know that, well, let's take in the 2000s when we had the housing market go down. Or in the 80s, you can look at either one of those. But
Right.
let's say I'm living my life, right? And it's the 2000s and I've saved my whole life to retire, right?
Yep.
Saved and I got my house, I got everything ready. I'm all about to retire. I'm very excited. I've worked my whole life for this. Market's doing good. Housing market's booming, right?
Right.
And all of a sudden, what happened? Everything crashed, right? We all saw our retirement accounts go way south. Can you imagine having to start tapping into your funds at that time?
Right. Right,
Every
because
dollar would
you'd be
cost you
tapping into funds.
$3.
What's that?
Every dollar would cost you $3.
Right.
You'd burn through all that retirement money. So, you know what, when the market's not performing, imagine you had a safety net out there somewhere. And we'll call that the reverse mortgage, okay? Let's say you had that safety net out there and the market's going down and you're thinking, but I need cash.
Right.
And you can't, you just can't do it because you know what? You may not live long enough to recoup this loss. So guess what? You have that little reverse mortgage that you took out and it's sitting there and it's there for the taking at 3.5% interest of what you use, and you don't have to make a payment on it if you don't want to. So you know what? When the market's not performing like you would like it, you go to your reverse mortgage and you can tap into that to help you get through those tough times.
You know, Nina, what you're saying is absolutely, look, in 2008, right, market crashes, a lot of people decided to they're panicked. They got to sell their shares because they're either not getting dividends or they're not getting increases in the amount of money they make from the stock portfolio. So they sell in order to get the cash they need to live. This way, you don't do that. There is an investor counselor or advisor out there who says sell when the market's bad. No, that's when you buy or that's when you hold on. So to get you through the hard times with the equity in your house, you certainly can obviously weather the storm, because I think the stock market came back roaring within 5 years, right? Within 5 years, it was doing better than it was doing before. So what do you do to bridge that gap? You're talking about it now, the reverse mortgage.
You're listening to a special edition of The Mortgage Voice with Jeff Barton. Jeff's guest is Nina Penny talking about reverse mortgages. Please proceed to segment number 3.